If you've ever looked at a stock chart and it just seems like a total mess, just a chaotic jumble of lines, well, you are definitely not alone. But what if I told you there's a way to find a real, clear signal in all that noise? Today, that's exactly what we're going to do. We're going to pull back the curtain on the tools traders use, and you might be surprised, it has way less to do with magic and a whole lot more to do with some pretty simple math and, yeah, a little bit of human psychology.
So really, it all comes down to this one big question, right? In all this chaos, all this apparent randomness, is there some kind of hidden order? Can we actually find something predictable in all that market noise? That's what we're going to try and figure out together. So let's just dive right in.
All right, here's the roadmap for where we're headed. First, we're going to talk about separating noise from a signal. Then we'll get into the power of averages. After that, something kind of cool called the Fibonacci prophecy. It's wild. Then we'll look at bands of probability to figure out what's normal, and we'll wrap it all up with the market's momentum engine. Let's get to it.
Okay, first up, from noise to signal. Before we even touch any of the cool tools, we got to understand the basic problem they're all trying to solve in the first place. So think of it this way. Imagine you're at a really loud party and you're trying to hear what one person is saying. All that background chatter, that's what analysts call noise. The one voice you're trying to lock onto, that's the signal. In the market, that signal is the real underlying trend. And all these tools we're about to talk about, they're basically just fancy ways to turn down the volume on the noise so we can hear that signal loud and clear. Okay, so how do we actually start filtering all that noise out? Well, the very first tool, the most fundamental one in the whole toolbox, is actually super simple. It's all about the power of averages. Let's take a look at how this works. A moving average is, you guessed it, exactly what it sounds like. It just takes the average price over a set number of days and plots that as a single continuous line on the chart. What this does is it smooths out all those crazy jagged spikes, the up and down noise, and it gives you a much cleaner line that helps you see the general direction things are headed. But of course, not all averages are created equal.
And that brings us to the two big ones. First, you've got the simple moving average, or SMA. It's simple. Every single day in its calculation, it gets the exact same weight. So the price from 20 days ago matters just as much as the price from yesterday. But then you have the exponential moving average, the EMA. Now the EMA is a little bit smarter. It's built on a different idea, that what happened just now is way more important. So it gives more weight, more importance to the most recent prices.
And here's why that matters. That extra weight on recent data makes the EMA react way faster to new information. So when a trend starts to change, the EMA is going to flag that for you a lot sooner than the good old SMA will. It's basically the sports car of moving averages. It's built for speed. All right, let's shift gears. We're moving away from simple averages and into something that feels, well, almost a little bit magical, but I promise it's still all about the math. This is where things get really interesting, where we see this bizarre connection between how a seashell grows and how a stock moves. And it all starts with this one special number, 1.618, the golden ratio. This thing is literally everywhere in nature. I mean, you find it in the spiral of a galaxy, the petals on a flower, even the proportions of your own body. And believe it or not, it shows up in financial markets too. And how do we get to this magic number? It's actually incredibly simple. You just start with 1 and 1. Add them together, you get 2. Add the last two numbers again, 1 plus 2, you get 3. Then 2 plus 3 is 5, and you just keep going. Now here's the cool part. As you go further and further down the line, if you divide any number by the next number in the sequence, the answer gets closer and closer to 0.618, which is directly related to that golden ratio. So, what does this have to do with a stock chart? Well, from that simple little number sequence, we get these key percentage levels. And the theory is that after a big price move, up or down, the market will often pull back, or retrace, to one of these special levels before it takes off again. Traders watch these levels like a hawk, thinking of them as potential support or resistance spots. But here's the kicker, the real secret. Does the market really care about some cosmic number sequence? Maybe, but here's a much more practical explanation. Thousands upon thousands of traders all over the world are taught to look for these exact same levels. So when a stock drops down to that 61.8% level, what happens? A flood of buy orders comes in from all of them at once, and that buying pressure creates the very bounce they were all expecting. It becomes a self-fulfilling prophecy. It's this incredible mix of pure math and mob psychology. All right, moving on. We're going to switch from geometry and psychology over to pure statistics. So if Fibonacci is all about finding these psychological hotspots, our next tool, Bollinger Bands, is all about using math to define what's normal and what's not.
And the magic words here are standard deviation. Now that sounds complicated, but it's just a statistical term for how much a set of numbers tends to vary or spread out. Bollinger Bands use this idea to draw a channel, a sort of river, around the price. And believe it or not, the recipe for these bands is super straightforward. You start with that 20-day simple moving average we talked about earlier. That's your center line. Then, you run a quick calculation to find the standard deviation, which really just measures how volatile the price has been lately. And you simply plot one line 2 deviations above the average and another line 2 deviations below. And that's it. That's your channel. Now, here's why this is so cool. Basic statistics tells us that for most things that follow a normal distribution, about 95% of all the action is going to happen within 2 standard deviations of the average. So these bands basically create a high probability zone, a normal range where the price should be trading.
But that raises a really important question, doesn't it? If the price is supposed to stay inside those bands 95% of the time, what about that other 5%?
Well, it means something significant is going on. A price move that's powerful enough to actually break outside of that statistical comfort zone is by its very definition an outlier. It's not just random noise anymore. It's a powerful signal that a big, strong trend might be just getting started. It's the market basically screaming at you, hey, pay attention to this.
Okay, last but not least, our final tool doesn't just measure direction or probability, it measures speed. Think of it like a speedometer for the market. It tells us how fast a trend is moving, and maybe more importantly, if it's starting to run out of steam.
This is the Relative Strength Index, or RSI, and what it does, in a nutshell, is it compares the average size of the up days to the average size of the down days over a certain period. So if the gains have been much bigger and more common than the losses, the RSI number goes up. If the losses are in control, it goes down. Simple as that.
So that calculation gives you this really handy gauge that runs from 0 to 100, and there are 2 key levels you need to know. Anything above 70 is generally considered overbought. That's a sign the buying has gotten a little too aggressive. And anything below 30 is considered oversold, which means the selling has probably been overdone.
Honestly, the best way to picture this is to think of a rubber band. A market just can't keep stretching in one direction forever without a pause. When that RSI gets above 70, or overbought, or it drops below 30, oversold. It's just like that rubber band is stretched to its absolute limit. Now, it doesn't guarantee anything, but it's a pretty strong clue that a snapback in the opposite direction is becoming more and more likely.
And that really brings us full circle, back to our big question. We've seen how all these tools use simple math, averages, geometry, statistics, to try and find a signal in all the market noise. But here's the final thought I want to leave you with. If thousands or even millions of traders all see the same EMA cross, or the same Fibonacci level, or the same overbought RSI reading, and they all act on it at the exact same time, at what point does it stop being about the math and start being about the psychology? Where does one end and the other begin? It's something to think about for sure.